pause for 10 seconds, because this isn't a someday story. It's moving right now. What flipped in the past 3 days is the kind of switch that rewires markets quietly, then hits your bank account loudly. While headlines cheer record stock prints, a separate clock is ticking underneath the entire money system. And the hand that S about to smack the table is a single announcement. President Trump, yes choice for the next Federal Reserve Chair. Prediction markets are already pricing a frontrunner, and the odds change fast enough to matter. One name surged from the maybe pile into the lead, and another jumped after Trump publicly complimented him on TV. It's not just politics. This is forward guidance with teeth. Here's the part most people miss. The moment a rate-cutting, Trump-aligned chair looks inevitable, the last psychological speed bump on the weaker dollar, trade disappears. What happens when that speed bump is gone? Money runs into anything that can't be created with a keystroke. And that AMSY silver, already in a historic move, could go from strong to disorderly. Did you notice how different the price looks depending on where you are in the world? What if the number on your screen isn't the number that actually buys metal anymore? On Tuesday, January 27th, paper silver jumped hard, over 6%, printing around $111 on U.S. futures. But in Shanghai, physical metal was closer to $131. Japan hovered around $130. UAE quotes pushed roughly $135 for prompt delivery. That's not a tiny premium, that's a split reality. Some U.S. dealers aren't merely low on stock, they're pausing sales, shutting the doors, or refusing to quote because replenishment is breaking down. When supply chains stop quoting, it doesn't feel like a rally, it feels like a run. When trust breaks, price becomes a rumor. If you're here for the unfiltered version, welcome to Business Limits. And stay with me, because the trigger isn't silver hype. The trigger is policy expectations, plus a physical shortage that's starting to behave like a liquidity event. Let S start with the spark. Why a Fed chair pick can move silver before the new chair even sits down. Jerome Powell's chair term ends in May 2026, less than 4 months away. Over the past year, Trump has hammered Powell publicly for not cutting quickly enough, floated legal threats around the Fed building renovation overruns, and repeatedly signaled he wants a different direction. The point isn't whether a president can fire a chair. The point is, Trump doesn't have to. The seat is about to open, and whoever fills it will be interpreted as a mandate. Lower rates, easier money, and supportive conditions for markets, because those are politically rewarding. But what's the trade-off? A currency that buys less over time. Isn't that the exact setup that drives people toward hard assets? According to reporting, and officials involved in vetting, there are multiple finalists. 2 names are now dominating the betting boards. Kevin Hassett, currently leading Trump's Economic Council, and Rick Rieder, a high-profile fixed-income leader at BlackRock. Other credible options include a former Fed governor and a current Fed governor. But the key is what the market believes about the policy stance. The leaders are viewed as doves, and doves change everything, because the market doesn't wait for May. It front-runs the future. Here's the chain reaction in plain English. A more dovish chair implies faster rate cuts, easier financial conditions, and a weaker dollar path. A weaker dollar tends to lift real assets, commodities, metals, property, because the measuring stick is shrinking. So when the crowd senses debasement, it runs to things that don't dilute. What happens when deficits are enormous? Interest expense is brutal, and the easiest political answer is keep rates lower. Even mainstream market notes have begun describing what S happening as investors rotating out of paper promises, bonds and currencies, and into tangible stores of value amid fiscal blowouts across major economies. Translation: they think governments will choose printing over pain. And if Trump appoints someone aligned with that preference, it's not a surprise, it's confirmation. Now, the story gets serious when you move from price charts to the physical market, because the physical market is where paper narratives go to die. A near 20% gap between a major Asian physical hub and U.S. paper pricing is not normal behavior. That's the market telling you. Deliverable metal is scarce, and the screen price is an abstraction. Ask yourself, if you needed metal for manufacturing next month, would you care about a futures print or a warehouse quote that can actually ship? In China, trading in yuan-denominated silver contracts has surged, and the pricing has been noticeably higher than U.S. benchmarks. Volumes have exploded as speculators, industrial buyers, and investors pile in. Why? Because on January 1st, 2026, China rolled out strict export controls, effectively tagging silver as strategic, dual-use material, closer to the category of critical supply than simple commodity. Only a limited set of companies received export licenses for the next 2 years. Think through the implication. A major processing and refining node just tightened the valve. When the valve tightens, the price is set by scarcity, not by a trading desk's model. And if China decides it would rather keep metal inside its own ecosystem, The rest of the world competes for a smaller pool. There's also a geopolitical layer people underestimate. Silver isn't just jewelry or coins. It's embedded in modern systems. Solar, EV components, phones, military electronics, and data centers feeding AI workloads. Control the inputs, influence the build-out. So when Eastern markets pay up and lock supply, the West can't paper its way to more atoms. And here is the uncomfortable question: what if the real price is the one that clears physical, not the one that clears leverage? Now zoom back to the United States, where the physical distribution network is showing stress in a way most casual investors have never seen. Dealer inventories for common products have been wiped thin. Popular sovereign coins, generic rounds, large bars, even the stuff that's usually everywhere, starts to feel scarce. But why wouldn't dealers just restock and cash in? Because the middle layer is freezing. Wholesalers, the buyers of last resort who keep dealers liquid, have started going no bid. That means they're unwilling to quote buy prices, not because demand is low, but because their risk system is screaming. If you're a coin shop and someone wants to sell, you normally buy and flip to a wholesaler to free up cash. When the wholesaler steps away, the dealer can't recycle inventory, so the whole chain stiffens. So what's causing wholesalers to step back during a raging bull move? It comes down to a standard practice that becomes lethal during fast spikes: hedging physical inventory by shorting paper contracts. In calm times, it's sensible. But in a sharp upside move, that short position bleeds and triggers daily margin calls. The cash demanded by the exchange doesn't come from thin air. It comes from working capital. As silver surged from lower levels into triple digits, margin calls stacked up morning after morning. Credit lines get used, cash buffers vanish. Eventually, the wholesaler protects survival by refusing to take more inventory. That's when you see no bid behavior and sudden pauses in operations. It's not a one-off. It can turn systemic when everyone uses similar hedges. Does that sound like a healthy market, or a market that's losing its shock absorbers? Even the US Mint has shown strain, delaying certain releases and struggling to price products when the underlying metal swings too quickly. When an official mint can't confidently set pricing because volatility is too violent, that's not bullish excitement. That's operational stress. Now we need to talk about the number that makes this bigger than a metals story. The scale of the paper universe tied to silver, because that's where a localized squeeze becomes a financial event risk. The physical silver above ground is sizable in ounces, but in dollar value, it's still relatively small compared to the financial instruments built on top of it. Rough math. Estimated inventories around 1.5 billion ounces multiplied by roughly 110 gives you about 165 billion in metal value. Manageable, until you remember that the paper claims are multiples of the physical base. Industry estimates often put the notional exposure from futures, options, swaps, and other derivatives tied to silver well into the trillions. Add in related hedges that link across rates and currencies, and you approach a figure around $1.7 trillion in interconnected exposure. The issue is an estimate T that every contract demands bars tomorrow. The issue is what happens when physical pricing separates from the paper reference that those instruments assume. When Shanghai trades far above US paper, you get a mismatch. Contracts settle on a benchmark, while real buyers pay the street price for deliverable supply. Widen that gap enough, and something has to give. Either the benchmark reprices upward to regain credibility, or the benchmark loses authority and the derivatives complex starts malfunctioning through forced cash settlement, failed hedges, and cascading counterparty stress. What happens if the price can't buy the thing it represents? There's another angle: the broader rotation out of paper assets. Large institutions have reasons to worry: deficits, debt loads, interest costs, and political pressure that favors easier policy. When capital begins leaving sovereign bonds and fiat instruments, it looks for alternatives: metals, commodities, and real assets. That flow can be enormous, and it doesn't need everyone to panic, just a small reallocation from very large pools. Paper can promise. Metal can settle. Now we hit the shadow chair effect, the concept that explains why the Fed pick can move markets immediately. Powell stays chair until May, but a nominee announced in late January becomes the market's focal point. Traders start pricing the next regime as if it's already here. This happened in past transitions. Expectations moved yields and currencies before the incoming chair had formal authority. So if the nominee is perceived as aggressively pro-cuts, markets will position early, sell dollars, buy inflation hedges, accumulate hard assets. That front-running becomes self-reinforcing, and it can overshadow current Fed messaging because the crowd believes tomorrow's policy path matters more than today's press conference. Can you see why one announcement can accelerate a move that's already underway? There's also a darker scenario. If political pressure leads to an early resignation or an unusually messy transition, it would amplify doubts about central bank independence. When independence is questioned, currency confidence tends to weaken. And when currency confidence weakens, the bid under gold and silver strengthens, because they are assets no committee can print. So where does this go next? There are three broad endings, and each one favors physical metal over paper exposure. Ending 1, the paper benchmark surrenders and reprices upward to meet physical reality. That closes the gap the clean way, but it requires the system to tolerate higher prices without trying to choke them off. If it happens, silver doesn't just drift higher. It can leap. $150, $200, $300 becomes thinkable as the gap closes. Ending 2, the split becomes permanent. Paper silver remains a speculative arena with its own rules, while physical trades through tighter channels at higher levels. 2 parallel prices. In that world, the screen quote is entertainment. The real economy uses the deliverable quote. Once credibility cracks, rebuilding it is hard. Every inventory drawdown, every margin hike, every sudden wholesaler pause pushes more participants toward physical settlement. Ending 3, the harsh reset, force majeure, or de facto failure to deliver at scale. That means contracts get paid out in cash at a benchmark price even when real-world metal is far more expensive or unavailable. If that occurs, trust in the benchmark erodes rapidly, and physical pricing can gap higher in an ugly, discontinuous way. This is the nobody wants it until everyone needs it outcome. Now, the practical question. What do you do if an announcement could land any day? You don't need to predict the exact nominee to understand the setup. First, if you already hold physical, think carefully before letting it go just because the paper chart wiggles. A margin rule change can slam paper prices temporarily, but it doesn't create new bars in warehouses. If your goal is protection, don't confuse noise with supply. Second, if you're considering buying, recognize what you're actually competing for. Not a ticker symbol, but inventory. Premiums, delays, and out-of-stock notices matter more than the spot quote when supply is tight. Can you wait weeks if you need it now? Third, be cautious with products that can be cash settled or structurally divorced from delivery. If your thesis is physical scarcity, your instrument should match the thesis. Otherwise, you may win a trade and still lose the outcome. Fourth, prepare psychologically for volatility. Between now and May, the range of outcomes is wide. Sharp spikes, violent pullbacks, policy rumors, and liquidity crunch headlines. Staying calm is an edge. Staying informed is an edge. And finally, if this breakdown helped you see the moving parts, hit like and subscribe to Vantage Economics. It tells YouTube to show this to people who want the real mechanics, not the cheerleading. Because the most important takeaway is simple. The price isn't a TIA number, it's a system. And systems can glitch, split, or reset. The Fed chair announcement might be the spark, but the fuel is already stacked. Tight physical supply, rising premiums overseas, hedging stress, and a derivatives tower built on a small base of metal. Watch the nominee, watch the dollar, watch the physical premiums. And most of all, watch whether paper and physical keep drifting apart, because that's when a market turns into an event.